Swamadath, and all of my coworkers. We are delighted at ARC to sponsor Dr. Palim's session today. As one of the panelists mentioned earlier, Natalie Overturf, go online and type in lowest price and see if your name comes up. ARC's name probably doesn't come up. It's not our space, but we will help you save time, stay compliant, and earn more money. So that's my golden sounding of the trumpet for ARC today. But right now we're here and just delighted to welcome back Dr. Mark Palim from Fannie Mae. And Dr. Palim joined us several years ago at this conference and spoke to us in person. He's kind enough to join us again today. Dr. Palim is Vice President and Deputy Chief Economist at Fannie Mae. He is responsible for overseeing the corporate, macroeconomic, and housing forecast functions for Fannie Mae. In addition, he manages multidisciplinary partnerships across the company to address specific business issues facing Fannie Mae. He's a key spokesman on economic and housing market trends, a frequent speaker at national mortgage finance and housing industry conferences. Previously, Dr. Palim was a staff economist for the National Association of Federal Credit Unions. And I know we have some credit union members on here today. Dr. Palim has a Ph.D. in economics from George Mason University and a BA in international studies from Johns Hopkins University. He's a native of Brussels, Belgium. On behalf of our sponsor, American Reporting Company, please join me in welcoming Dr. Mark Palim.
Well, thank you very much. I really appreciate you including me in today's meeting, and very sorry we're not meeting in person. And I know we've all it's been isolating, and it'll be terrific when hopefully we can all get together again. So I have a presentation, as you might expect, and we'll share that in a second. And I wanted to very much, but before I do that, encourage people to ask questions, and we'll have time at the end definitely for questions. But also, if during the session you have questions, I think maybe use the chat or unmute yourself the old-fashioned way and interrupt me. And it's a small enough group, I think we can do that. So let me see if I can share my screen here. I'm having a little bit of
Dr. Palim, this is Mindy. I have your presentation if you'd like me to run it for you.
Oh, that would be way better. I really appreciate that.
Okay, sure.
We have this issue with Zoom. Unfortunately, it's not yet an approved application at Fannie Mae, so I have to jump to my personal iPad and then try and, so that would be fantastic. Really appreciate it. So if we turn to the next slide, I just want to start off with the quick disclaimer. And normally it really is a quick disclaimer, but I think it's useful, as you're all aware from your businesses, to remember that we are still in the COVID pandemic, and that makes forecasting a little bit more of a scenario planning exercise than a pure forecasting exercise. So I think that is just good to keep in mind as we think about the baseline and we start thinking about the risks. So maybe we can turn to the first slide.
Yes, just a moment. I was switching the way that this is presenting.
No, I really appreciate it. Thank you.
Mm-hmm. Okay, there you go. All right. Do you got it?
Yep. Let's see if it let me. Now, should I drive it, or are you going to change? Can you rotate the pages?
Yes, I can rotate them for you.
Perfect. So maybe we can go to slide 3, the first graph. Really appreciate your help. And so the good news is, despite the slowdown that we're currently experiencing in the third quarter, and as we start to consume the data for the third quarter, is that at the end of the second quarter, in terms of GDP, we were practically back to the trend, which is a terrific improvement, obviously, over where we think we were in the midst of the pandemic, in the early part of the pandemic a year ago at this time. And you can see that in blue on this graph that real GDP has come back to basically its trend. That's been driven this spring by consumer spending as the economy reopened. Obviously now in August, that's begun to slow down, and like other forecasters, we've been marking down our forecast for third quarter growth. But we do think things will start picking up in the fourth quarter and then again next year as we get through another winter of COVID, and hopefully that'll be the final winter of COVID. One of the things that needs to happen during the coming 12 to 18 months, but definitely sooner than later, is to get to a more balanced growth where we see not only the consumer driving growth and deficit spending driving growth, but we actually see a pickup in investment. We see a pickup in global growth, which helps exports. So that's going to be a key transition to watch. If we go to the next slide, I have a little bit of survey data around that question about capital investment and what do people expect to do on capital investment. Here I've given you two different surveys. In the dark blue is CEO survey of large companies, asking them what they expect to do. And on the right in light blue is the small business NFIB survey. The good news is that both surveys, as of the summer, we're talking about both sides of businesses were in the surveys indicating that they were going to pick up in their capital investment and do the investment we need. In a second, you'll see why that's really important, because the labor market has gotten very tight. And in a tight labor market, you need increased capital investment in order to be able to sustain growth. Part of that you can see on the next slide, which is with the strong pickup that we had in consumer spending on goods during the pandemic. We've actually seen inventories in the business sector really drop off. So businesses need to rebuild their inventories. And this is the net share of firms reporting that their inventories are too low. And you can see that number is just way above where it would normally be. Obviously, the troubles that we're having in terms of restarting the global economy, the shortages of semiconductors, the number of ships that you see docked outside of LA waiting to land cargo from Asia. And now, because this wave of the COVID pandemic is really hitting Northeast Asia hard, and our supply chains for goods are very much integrated with China, Taiwan, Japan, Korea, Vietnam, Indonesia, all those countries that are part of the Pacific Rim, being hit hard by COVID. That's adding more trouble to the supply chain disruptions. So I think it's going to take a couple more quarters for all of that to work its way through. Unfortunately, I just think that's where we're at. If you go to the next slide, you can see here on looking forward, where do we stand for the consumer demand and consumer spending? On the left side, I've given you the amount of funds in savings accounts of the nonprofit and the household sector. And you can see that number shot way up. It actually went up by $2 trillion with the impressive amount of stimulus that we had last year and the beginning of this year. And most consumers didn't lose their jobs. And for those who did, many of them were covered by higher pandemic unemployment payments. So the household sector is actually coming out of the recession that we had last year in a relatively good shape, and particularly good shape in terms of liquid assets on hand. For the forecast, what that means is that we don't know when consumers will feel sufficiently confident to actually start spending some of this money. Obviously, we've seen that a little bit in the used car market, where over the last few months, used car prices have been up, I think, a cumulative about 30% now, so there's a lot of pent-up demand there. But if we look at consumer sentiment, which I've given to you on the right side, consumer sentiment, you can see the dive it took during the recession, and I should have noted in the beginning on all these charts, the gray area, the shaded area is actually recession period. So you can see the very short recession we had during the COVID pandemic. And when we came out of the COVID pandemic in the spring, when things were reopening, consumer confidence picked back up. But now with the increase of the Delta variant really hitting in July and August, you see the pretty significant drop in consumer confidence. So obviously that is an issue for the outlook, both for the housing market, but really more generally for consumer spending. We'll have to wait and see in terms of when do consumers feel confident enough to really go back to a fully open economy and spend some of this saved up savings that they have. That does create a potential for a pretty significant boom. And obviously, as we'll talk about in a minute, there's concern about inflation on the horizon. We got a great inflation number this morning. It was lower than expectation, which was good to see, but the risk is still out there. If we go to the next slide, I've got the first of several having to do with labor markets. This slide tries to put the experience that we've all been through into a bit of perspective. So what I've provided here is for every recession going back to World War II, how far did employment drop and how long in months did it take to come back to where it was? So you can see the current cycle, 2020, and the recession went through because of COVID is in the shaded line. And then the 2008 one, the 2007, 2008 is that light green one. So the good news is that we've seen a significant improvement in the job performance and in the job market and in employment, total overall employment. Unemployment is back down to the low fives. That number is just a touch too positive than the reality because we've also had a significant number of people leave the labor force, which is why this number is still a little bit lower. We're short another 4 million jobs from where we were at the peak, but it's still an incredible recovery over the last 12 months. As you saw in the first slides, output is actually all the way back to where it was pre-crisis. So the fact that employment isn't tells you that people are working harder and there's been some productivity gains. And if you go to the next slide, we can see a little bit of evidence of how we've been able to bring production all the way back to where it was, yet employment isn't there where it was. On the left side, I've got answers from a survey asking people how they have used the time that they've saved by not commuting, both for families with children and without. And you can see from the left two bars that working at their primary job has used up a little bit over a third of that time. So if you feel like you're working harder when you're working from home at longer hours, you're not alone. I think that's been a pretty uniform change that we see across the data. And obviously people who can't work from home, and that is a substantial amount of the workforce too, they're also working harder too as businesses, of course, are a little bit cautious about rehiring until the pandemic is completely over. If you look at the right side, you can see what that means for hourly earnings and time worked. You can see in the aggregate sense that hours worked is up 2.2% year over year in blue, in wages up, but they're not really up out of the extraordinary, out of an ordinary amount. If you look at that red line, they're up 3.7% year over year, but that's in line with what they were doing pre-pandemic. If we turn to the next slide, I wanted to give you a little bit of a sense of what's been happening in the Pacific Northwest and some data on non-farm payrolls to show where we are relative to before the downturn. So what I have here, both in the map and on the table, is a change in non-farm employment from January 2020 and what the cumulative changes in percentage terms. You can see there in the Pacific Northwest and the Seattle area, we're still down about 5%, moving down towards Portland into Oregon. It depends a little bit by the MSA, but it's still also down. Moving to Idaho, stronger numbers. That's one of the places, one of the few places in the country where we're actually up since January 2020 and I'm sure that's a combination partly of people moving to that area, not only people who were living there in 2020. But just wanting to give you that perspective, since ultimately the level of employment in a particular geography is just such a key driver for the housing market. If we look at that at a national level on the same slide, on the next slide, I'm sorry, we've got a map of the United States showing the same sort of data. And you see a couple of patterns that have emerged. One of them is, as we saw before, Idaho doing really well, Utah has done well. So you've seen some job migration a little bit out of the densest areas, which is like California, particularly the Bay Area, if we broke it out, is not doing quite as well. New York has been affected by departures out of the New York metro area. And you've seen also a little bit of weakness in particularly Louisiana, having to do with the oil industry. And then obviously Hawaii there on the left, really having to do with tourism. And tourism in Hawaii have gotten hit really hard. If we go to the next slide, you can see a little bit more of some of that detail I was just talking about in terms of the industry impacts. When we think back to the beginning of the pandemic, we knew that employment would be hit hard in leisure and hospitality, as you can see on slide 11. Then on the next slide, I'm sorry, you can see that we've got this broken out by industry, giving both where employment stood in January as opposed to January 2020 as opposed to August. And you can see the share of employment and then what the change has been. Just take you to the right side of the chart. Leisure and hospitality is the one laggard. Most other industries have caught back up. And you can see that here we've got a little bit of work to do left. And obviously the high frequency data that we're getting having to do with bookings and things like that, as you might imagine, is also showing some weakness, which is on the next slide. I'm sure some of you are also tracking this data, looking at, for example, on the left side, we've got restaurant bookings, and then on the right side, TSA. One of the things that has definitely affected the travel industry is that while over the summer we did see a really strong pickup in tourism by individuals and families, in the fall you've seen again businesses push off, and we're here virtually, push off business travel, and so that's normally you have a transition back to the business travel in the fall, which obviously isn't happening for the moment. Next, I wanted to spend a little bit of time talking about interest rates and Federal Reserve policy. Here, as you all know, the key thing everyone's been watching is when will the Fed maybe begin tapering? So tapering being the terminology of reducing its asset purchases, eventually maybe actually even letting them run off or selling them. We're obviously quite a ways from that. Let alone from the Fed actually raising interest rates. But, excuse me, to give the foundation for the conversation around interest rates, I'll just start off by showing you what our current forecast is. As some of you know, we use the forwards market to do our forecast. We've learned over the years that Mr. Market's probably a better forecaster of interest rates than we are. So you can see here where we expect rates to be at the end of December. This is from August 10. We're currently working on our next forecast, but you can see at that point we had the 30-year mortgage being at 2.9 at the end of 2021 and then 3.2 at the end of 2022. So a very gradual rise in interest rates, not a dramatic increase as the economy continues to recover. If we go to the next slide, what are the things on the mind of policymakers? Obviously, the first one is always where they're setting short-term interest rates, and the slide on the left gives the so-called dot plots, which is something that the Federal Reserve releases after its meetings, providing information on where the voting members think that rates are going to be, what their individual forecast is. And you can see for the Fed funds rate, you can see in where they think it'll be in 2021, 2022, and 23. So they have it a little bit drifting up. In our minds, the earliest date when we think there might be an increase in the Fed funds rate would be beginning of 2023, based on our forecasts and where we think growth and inflation will be. By way of contrast, you can see in that last column, the dots associated where the members of the FOMC think rates would normally be in the longer run at full employment. And you can see they have that target 2.5%. So needless to say, we've got a ways to go. In terms of the longer end of the curve, what's been happening with the Federal Reserve's portfolio, you can see that on the right side. And I think what this illustrates is just how extraordinarily rapid the intervention was last spring. If you go back to 2008, so the beginning of that chart, the Federal Reserve's balance sheet is at $1 trillion. It takes them all the way to 2014 to take it up by another 3 trillion to the 4 trillion number. And then you can see in 2018 when they start to taper and let some securities run off. And then there was a little trouble in the repo market, so they sort of stopped. But subsequent to that, obviously, with the last spring with the COVID crisis, and how markets locked up in the very early part of that in March, you can see the dramatic increase. So in a month, they increased the balance sheet by the same amount that it had taken them from 2008 till 2014. So really very much uncharted waters. As I'm sure you've read, the Fed is starting to signal that they're thinking about when they might be able to start reducing their purchases. So that's we've got a ways to go here, and I think it's going to be very interesting to see how much they'll be able to reduce their purchases at some point, or will other circumstances intervene and they'll end up owning a lot of this for a lot longer than they might like to admit. Obviously, one of the key drivers of that is what's happening with inflation. And if you go to the next chart, this gives you inflation through July, so it doesn't include the August number that we just got this morning. I'm sorry. And but as you know, and I'm sure I've been reading about, we've had a shoot up in inflation as we reopen the economy, and we've had this whole discussion of what is transitory and what is permanent. You know, what's one's definition of transitory, right? So great to get a better number this morning with the headline rate coming down in the year over year. What we have seen in the data, and we think is going to persist, is that home price appreciation and rent appreciation remain reasonably. Obviously, home price appreciation has been very strong. Doesn't actually go into the CPI or into the PCE, which is the favorite measure of inflation for the Federal Reserve. But what does go in there is an estimate of the rental value of housing, and at least previously, statistically, it takes about 3/4 for the home price appreciation to start to get reflected into that measure. So we think that, you know, inflation is going to stay up a little bit. It's not going to be at that 2.5% level or that they've been targeting. It's going to stay a little bit above that. And it's definitely going to be above where it was last cycle, when it was, you know, closer to 1.5%. So if we move to the next slide, one of the key drivers of what the Federal Reserve decides to do with interest rates and how quickly they move it, they have to move more quickly than they would like, has to do with expectations. So one of the issues that they have to watch for is they try to fine tune their monetary policy to get just the right amount of pickup in labor markets, but not too much inflation, is whether a psychology or mindset around inflation starts to kick in. For those of you who remember the 70s or have studied the 70s, back then you had a psychology that set in that then affected real behavior. in the sense that labor contracts would have cost of living adjustments. People expected inflation to keep increasing year after year. So this chart shows you a couple of measures of inflation expectations for consumers. In the yellow line, you've got the 1 year ahead forecast, or what the average respondent is saying what they expect inflation to be. And that seems pretty reasonable, a little under 5%. Is consistent with the incoming data. And then when they ask whether they think it'll be 3 years ahead, that's the red line, it's a little bit lower. And then 5 years ahead is the bottom line in blue. But as you can also see by looking at those 3 lines on the right, the 3-year number has drifted up. The 5-year number sort of moved up a little bit, but it hasn't broken out far from the range. And the Fed has told us that they will tolerate inflation being above 2.5% for a while in order to make up for the years when it was well below their 2% target. So we will see how this develops and what happens to the mindset. But this is one place where plans could get upset if you see inflation expectations really picking up. The Fed will feel forced to respond to that. As I mentioned, and you can see this on the next chart, we do have some inflation going on in the residential sector, which isn't yet being picked up, but we think it will get picked up over time. In yellow, I've got rent increases based on what's on apartmentlist.com, and then in red, rent acts from Real Page, and then in the blue colors is measured rental inflation from the CPI and the PCE, and you can see those typically run together pretty well. For some reason, the presentation seems to have moved ahead a little bit. But if we go back to slide 18, you can see that. That's fine. You can see the inflation expectation here. On the next page, you see what's been going on with rents. We think that that's going to pull up the blue line, that we can't have this gap persist. And if we go to the next slide, you can see what the relationship has been typically between house prices and this component of inflation. So you've got the house price measure from CoreLogic here in red, and then the inflation measures for the assumed rental value of owner's property. And again, the red line tends to lead, and it isn't a perfect relationship. It does suggest some inflation coming from the housing sector into those numbers. The other place where there is risk for the Federal Reserve and where there's risk for interest rates is just how tight the labor market is. And one way to illustrate that is the data that is on the next slide. Currently, what this chart shows is a ratio of the number of unemployed people per job opening. So if you go to the left, coming out of the 08 recession, you can see that there were over 6 unemployed for every job opening, and as the economy started to expand, that number came down and gradually down until it was about around 1 in 2017, 2018 time period. What's really notable about this current recovery period is how quickly we've come back to that ratio of 1, right? So if you've been out looking for people for your team, you know how tight the labor market is, and I think this helps illustrate that. Employers really have a very large number of positions open relative to the number of unemployed who are currently looking for a job. Obviously, that then gets into a discussion of what's happening to the labor force, because the unemployed only includes those who are actively looking for a job or from the last 3 months. We have seen a decline in the overall size of the labor force. If you go look at this period here from 09 through 2020, one of the things that helped sustain growth and employment was that we saw the labor force participation of people over 60 years old really increase. There was not a great increase for people 25 to 60, but there was an increase for people over 60. One of the risks to the inflation outlook and risks to the for economic growth in terms of what potential employment can be and what maximum output can be before inflation takes off is what do older Americans decide to do in terms of labor force participation? And clearly there's a COVID effect, right, given the relative risk at different ages. And there's plenty of anecdotal and some survey evidence that people will have accelerated their transition into retirement. For some, the strong stock market will have definitely helped. And in the housing market, you I think seeing part of this effect when you look at home sales in places like Florida, and you look at the level of cash sales, but you also see it in North Carolina and some other places that people in the past have retired to. So speaking of labor shortages, if you go to the next slide, have a little bit of survey evidence telling us where things currently stand on a monthly basis. So this again is data from the NFIB. They do great surveys of small business, ask a whole bunch of questions every month. One of the questions they ask is does your firm have positions that it's not able to fill? And you can see that in the blue line. And firms are having open positions they can't fill at a record level, significantly above where it was in 2019 and where it was the whole of last cycle. And then another question they ask them is, are you planning to raise compensation in the next 3 months? So to what extent labor or employers willing to use offering higher wages to try to fill these positions? So you can see that number in red. It is up over where it was in 2019, but it's not up anything like as much as the open positions. So there's a little bit of a tug of war here. An employer is going to just leave the positions unfilled, and you can see the hours worked that we saw earlier on, demand more of their current team, or are they going to be willing to offer higher wages in order to try and induce more people to come to work? So on the next page, I've just rolled up what this all means, at least for our base forecast. Excuse me, you can see here on the top line what we're expecting for GDP for this year at 6.3%. So if we think about potential GDP, over the next 5 years, think about demographics, how much is the population growing, how much productivity gains could we have, what's going on within that population growth, the labor force participation, immigration, all the rest. I think most economists would say that potential GDP is maybe 1.8 to 2%. So the forecast that we have in here for 6.3 is obviously a bounce back, but even the 3.2 in 2022 is still pretty strong by historical standards. And given how large these numbers are, there's going to be some bouncing around in them as we get back closer to what potential GDP is in a sort of normal run rate. Unemployment, we have that continuing to come down for the rest of the year, and at the end of Q4 being at 4.4%. Next year getting down to 3.8%. That has the potential to keep inflation up a little bit, and you can see the inflation numbers just below that. Given what I showed you about interest rates earlier on, you're probably not surprised to see the interest rate forecast here for the annual average this year and next year. But that inflation number does put some risk on upward risk to that interest rate forecast. I just wanted to see if there are any questions in the chat. Well, since there aren't any questions, what I think I'll do now is maybe we'll move over to the housing outlook and the housing forecast. In the housing market, it's been incredible to watch what's going on with home prices. It's really been obviously the biggest topic of conversation. And the second one is clearly what does a post-pandemic housing market look like, and especially after the kind of home price appreciation that we've seen. So this gives you a little bit of a longer term perspective on home prices and what they've been up to. One way to think about this is since the start of the pandemic, home prices are up pretty much 20%. Depends on your measure, depends which one you look at. CoreLogic, FHFA, somebody else's, but all the price indices are up an unbelievable amount. You can see it in your, I'm sure in your local markets. Obviously driven by low mortgage rates, pandemic-induced desire for more space and getting away from density. And then also an increase in first-time home buyer participation in the market, which I think the stimulus payments probably, along with the low rates, is really the explanation for that, and likely pulled forward some first-time home buyers in purchasing a little faster than they might otherwise have. If we look at it on the next slide in terms of price tiers across metros, this is S&P Case-Shiller data that for the top 30 metros takes the bottom third, the mid third, and the upper third of price tiers within that metro and tracks them over time and aggregates them. The point simply here is to try to look sort of what less expensive versus more expensive markets are doing across the country, controlling for differences across metros. And you can see that in the recovery after home prices bottomed out in 2012, that dark blue line tended to lead the market and led the market. Those are the lowest, lower priced neighborhoods. And that's somewhat not surprising, right? As prices go up and affordability becomes a bigger issue, people are going to move a little bit more into those neighborhoods and price competition will heat up there. You also had a relaxation of credit standards relative to the immediate ones after the crisis, which also benefited more moderately priced neighborhoods in a relative sense, more than high priced neighborhoods. But what's really extraordinary is when you look at the right side, which is that the home price appreciation we're seeing now is strong across the board. It's in all price tiers, and we haven't seen that kind of uniformity in a long time. So I do think when you look at the last slide and this slide together, the rate of home price appreciation is obviously a concern, and it clearly can't be sustained unless you think that mortgage rates are dropping another 100 basis points, which is not our forecast, obviously. We have them only up a tiny bit. So there's going to have to be some significant slowdown in the rate of appreciation of home prices. On the next slide, I've given you a little bit of detail on your local markets in the Pacific Northwest. You guys know these markets far better than I do, but I just wanted to give that to you by perspective and a little bit of comparison. Not surprisingly, the Idaho markets being the strongest one, given the chart that we saw about employment and how that we actually have year-over-year in employment gains since the beginning of the pandemic. But you're seeing strength throughout the area across all of these different metros. So on the next slide, we can see a little bit about what has this done for valuations. So here we just look at two ways to think about home values. On the left side, we look at existing home sales price relative to median family income, and you can see that's sort of a multiple of relative to income. That number is up substantially. It's not yet where it was at the peak in 06, but it's getting darn close. And on the right side, we've got a measure of home prices relative to rent that we set at 1 in 1990, and then we watched that ratio through time. Here too, home prices obviously up 20%, rents are up 2 or 3%, so not surprisingly, that number has spiked too. So again, a little bit of a concern here for what's going to happen to home prices and how sustainable are they at this level once the pandemic comes to a close and consumers have a full array of goods and services that they can spend their money on. So what do consumers think about all this? What's their attitude towards the housing market? On the next slide, I've got the two of the questions that we do the National Housing Survey and ask on a monthly basis, ask a whole bunch of different questions about consumer sentiment towards housing. But this is one that sort of is pretty notable for the moment because of how much it's changed. One of them is the good time to sell in blue, and the other one is the good time to buy. beginning with the good time to buy, you can see since we started surveying in 2011, as home prices have gone up over time and affordability became an issue, you can see that number sort of trended down. But boy, has it dropped off sharply in the this year, right? You can see that on the right side. Consumers are really noticing the strong home price appreciation, and when we look into subcomponents and of the survey, really high prices is an issue that buyers clearly are aware of. And the flip side of that is the good time to sell. Whereas home prices went up through the decade, the good time to sell improved. Obviously, with the COVID pandemic, that dropped off dramatically. And then as the housing market reopened last summer and last fall, that started to improve. But that's even started to slip a little bit. So maybe the current prices on the good time to sell is affecting even sellers' mentality that they're getting a little bit nervous too. So looking at that sentiment and what is the role of mortgage rates and how important are mortgage rates in keeping things affordable. On the next slide, we've got one view into affordability and home prices and interest rates. So in red, we've got the mortgage rate, which obviously has come down enormously over this time period since 2000. We all know well, dipped below 3% currently, a little bit below 3%. You can see on the right. In the gray dotted line, I've given you our forecast. And then in blue, we've done an affordability measure. So nothing magical here, kind of what you would expect. If you assume people have a 20% down payment, and you take the average fixed rate mortgage for that particular month, and you look at the median existing home sale price, and you compare that to median household income, and you come up with a ratio, right? It's kind of like a DTI here. And you see how much of the share of income would have to go to pay for that house if everybody was moving that day, which of course they're not. Home prices can be much more volatile because it's only a small part of the stock that moves. But taking that hypothetical allows us to see what the role has been of interest rates. And you can see that in 2006, that number got around to the mid 20s, a little bit around 23, 24% area as a peak. And then as interest rates continued to come down and home prices dropped, you see that affordability measure in blue really improving. And then gradually over the last decade, as home prices went up, you see affordability deteriorate. So what I want to really draw your attention to is what's on the right, which shows you what that blue number would be at different rates. So you can see where it is currently, the 3% mortgage rate, the ratio is around 19%. If mortgage rates went up to 3.6, it would be at 21. And to get back to where they were at the peak of unaffordability in the mid 2000s, they would have to go to 4.4%. So yes, mortgage rates absolutely have been important. You can see from the decline in the blue line going with mortgage rates in that period from early 2019 to the end of the pandemic. But mortgage rates went up 30, 40, 50 basis points. It doesn't yet take you back to the unaffordability of the mid 2000s. But if you go to 4% or 4.4%, then you get there. As I mentioned in talking about what are some of the things that have driven the housing market, if you look at the next slide, I think people often underappreciate how important the COVID stimulus money has been for first-time home buyers and the magnitude of that. So we just do a stylized example here where we look at a couple with two children and say, okay, with one child, sorry, and take a look at what was stimulus if they had not lost their job last year. What would be the impact of the different stimulus checks relative to the down payment, relative to a down payment first-time home buyer? And the simple punchline is that they would have gotten an extra $11,400 and so. that goes a substantial way towards what you would need on a $300,000 home. And you can see why first-time home buyer market has been reasonably strong. If we go to the next slide, obviously an inadequate response in terms of construction over a decade is another reason home prices remain really high. And this is sort of the one chart, so my one favorite chart on supply. I know we've spent years talking about all the constraints that have held back supply for builders, whether it's labor or land, all the rules around permitting, environmental impacts, you name it, long thing. Most recently, it was lumber prices, a whole litany of things that make it harder to build. But whatever all the reasons are, you can kind of see the net effect in this chart. So in red, we've got single family starts per 1,000 households going back to 1980. And in blue, we have year-over-year real home price appreciation. And you can see how, if you go back, for example, both after the 80-82 recession and the 90-92 one, how as home prices begin to appreciate coming out of the recession, you do see that induces more supply. And in fact, it's really notable in both the 80-82 and the 91-92 recession, you can see how single family housing starts normally pick up at the end of the recession, stimulated by low interest rates, and then continue throughout the expansion. In this last period, from 2010 to 2020, you just didn't have that kind of response. So we have a decade's worth of under construction or inadequate construction in the single family space relative to our population, relative to past trends. And estimates vary pretty broadly depending on your method, but a shortage of 2.5 to 5 million is within reasonable ranges. I think the number's probably towards the lower end, but suffice it to say, that's several years of single family housing starts that we're missing. And it's one of the things that has really caused the increase in home prices. So where are we on the more frequent, high frequency data? We're looking over a couple of decades. If we go to the next slide, you can see single family starts and single family permits. In the middle of last year, the builders did an incredible job of figuring out how they could change the single family work sites, et cetera, how they could get people back to work. And you saw a real pickup in starts and permits happening. And then in the spring of this year, supply constraints really started to hurt the builder pipeline. Strong lumber prices, more difficulty finding labor. Semiconductor shortage has actually affected the single family business. When you think of all the heating and air conditioning, appliances, other things that have been on back order. So suffice it to say that number has started coming down, which is not great for affordability at all. And we're watching for the next few months. Our forecast has this leveling off and some improvement happening, but obviously it remains to be seen if that actually comes to fruition. Looking at the states most of interest to this group, if we turn to the next slide, you can see here I've got that same US number in yellow, and then the states of Washington, Oregon, and Idaho. Similar patterns across the states in terms of the recent pullback, and perhaps not quite as pronounced in Oregon, but it didn't pick up as much as it had in for example, Idaho and in Washington State. So a lot of similar patterns to what we're seeing across the country. The other thing we've noticed in the building data, that's in the next slides, is that because demand for new homes has been so strong, given the push for more space as people want an extra office. You're hearing from the builders that there's a continued increased demand for multi-generational housing, whether it's an in-law suite or whatever the arrangement might be. Builders have actually been selling more and more homes before they actually even start them. So there is sort of a backlog of work that the builders need to do, which has also led them to obviously not have any price discounting and to hold the line on profitability, given how strong demand is. So there is a pipeline of work that needs to get done that we think will help sustain the single family starts. But like I said, we'll have to see how it gets through the winter. If you go to the next slide, looking at existing home sales and new home sales together, if you look at the pattern on the left, obviously it was a trend coming in of improvement in both those numbers, particularly prior to January and February 2020 with the dramatic drop off. And as I've titled this slide, I really think we're in a period where housing is trying to find its place in the economy as it reopens. And I know it's shut down a little bit, particularly in some regions, but I think by the spring we'll be back to fully reopening, given what's going on with vaccine rates and hospitalization rates, et cetera. And hopefully we'll get back to the trend that we had been seeing before, particularly on the new home side, because if you think of the affordability constraints, if you're not building new homes, then you're not releasing existing stock for first-time home buyers. People are sort of backing up in rental, which puts upward pressure on rental rates, and obviously that hurts low and moderate income renters even more because higher income renters are not moving out. So the whole dynamic of how the housing market works, it works so much better when you have adequate construction. In terms of where are we for months supply, you can see that on the right-hand side. Existing home sales month supply, I mean, it's just been incredibly tight, right? We've gotten below 2 months. It used to be, we thought of 4 to 6 months as being kind of a balanced market, a healthy market. You know, sure, with all the tools for online shopping and video touring, you know, you don't need to drive around the realtor anymore to see every possible house. You can do it right from home or your office, and you can just go to 1 or 2 properties. It would be reasonable to think that maybe a balanced market is 4 months supply, but I don't think anyone thinks that 2 months or less is a balanced market. So we still have a significant shortage of existing homes available for sale relative to demand, and that's putting this upward pressure on home prices. On the new home side, it is a little bit better, but obviously that's much choppier given it's a smaller market, and the lags between starts and sales and things like that. So there's a little bit more optimism that we've got some balance in that market, but it's still fairly low too. Obviously, this bears watching as we think about the near term home price appreciation and continued pressures on affordability. If we look at what's happening at the regional level, on the next slide, I've provided on the left side, we've got home sales, and on the right, we've got the inventory. And you can see that the strong pop up in home sales that's happened across the region, the US there, and particularly strong bounce back in Seattle and in Portland, a little bit less in Boise, but I think that's really a relative story because Boise was so incredibly hot before the COVID crisis. And part of the issue is just the complete lack of inventory in Boise coming into this period. Inventory is just tight across the board, and you can see that on the right side, just as nationally, it really is in this region too. So for the mortgage market, where does this leave us? If you go to the next slide, you can see here what I've graphed is the monthly level of the MBA's purchase application trend, and You can see in the light blue, they've got 3 years here, 2019 in dark blue, 2020 in light blue, and 2021 in red. You can see in 2019 how much volumes got. The seasonals disappeared, and you had that significant drop off in the April-May period. There was really no spring market, but then picked back up over the summer in a very strong fall market. 2021 is starting to look a lot more like 2019, which in some ways is a good thing, right? It means we have a little bit more normal pattern of mortgage production and applications. So, you know, that's at least one positive thing, some return to normal there. We do think it's kind of tracking where it was, the difference being the home prices at 20% higher. If you look at the refi and the refi index on the next slide, last year obviously was an extraordinary year for refis, given what happened to rates and how much rates dropped. You know, but refi is actually holding up reasonably well this year, as you've had you had some spikes in rates, but you've also had some significant dips in rates. So it's turned out to be nothing like as bad of a market as one might have worried. And if we go to the last page, you can kind of see that. Here we've got the housing forecast, and maybe I'll start at near the bottom since we're talking about originations. Four from the bottom, the purchase mortgage market origination. You can see how well that did in 2020 with the strong second half of the year, up 24% over 2019. We have that this year still being up 11% from the previous year, so that's still a substantial growth. And next year we have it only going up 6.9%, so it's still a decent growth, heavily based on home prices, a little bit based on particularly the pickup in new home sales. And then on the refi, you can see the refi numbers. We think this year will be $2.5 trillion, which is still a really large market. Last year will have been a record at 2.9. And then above, you can go to the housing market and see where we think what's driving that. New single family home sales, because of the weak market we've had in late spring and early summer, we think by the end of the year, that'll actually be down 2%. Next year will be up because there's strong pent-up demand in that area, up by 8%. And then on existing home sales, a little bit of the opposite story. Where this year it should be up 4%, but then we think it'll be down next year because we've pulled together a fair amount we think we've pulled forward a lot of first-time home buyers, and first-time home buyers are predominantly buying existing homes. So there's a little bit of give back there next year. On the home price forecast, this was August forecast at 14.8 for this year, and then moderating to 5% next year. I will say that we're getting ready to release this September macro and housing forecast. As some of you know, we only update the home price forecast on a quarterly basis. So in October, we'll be releasing a new home price forecast. But given the momentum in home prices, it's probably going to be a little bit up from this, given the actuals that we're going to be adding in. So anyway, that is the extent of what the slides I had to share, and I would love to hear any questions that people may have or topics on your mind and issues of concern, either in the economy, the market, or as they affect your business.
Hey, Mark, it's Robert Lipston. Thank you so much for your presentation. We so appreciate you showing up for the conference and bringing such great content. One of the things that you and I talked about up front before the conference, and I don't know if you can answer this or not, is I do get a lot of questions about the actual appetite from Fannie Mae on some of the scale backs, such as the non-owner and the second homes. Is that something that you could address?
So I'm probably not the best person to address that, and in some ways, maybe I think you had Dave Stevens on earlier, because it's really a policy question. It's not a forecast question. As I'm sure everyone's well aware, with the changes to the PSPA, the amendments that were made last year, and implementing those is something we've been working through. And so it's really a matter for policymakers to decide where do they want the emphasis to be for the GSEs, and where do they want our risk appetites to be? I know it's not a great answer, but
You're fine. There is one other question that I had, and this came in, and that is, obviously we're all hearing the words today in our presentations about tapering, and sitting in your role and position, and where the world is at with negative interest rates, et cetera. What's your opinion on if the agencies were to taper and start pulling out, where the trigger on rates would go and the private sector stepping in and purchasing mortgages?
yeah, so it's a really great question. I mean, you're right to frame it in terms of global rates, right? So the Fed has increased dramatically its balance sheet. The 10-year in the US is, I think, 1.3 today, somewhere around there. The 10-year in Germany is still negative. The Japanese 10-year is just slightly positive. So there is a huge appetite for US fixed income product, even at these rates. And I remember when I started working at a bank in Baltimore in the late 80s, my first job out of school, and the 10-year went to 10% in June of 1988, you know, and everyone was standing around, oh, it's gone to 12, you know. So with that in mind, it's unbelievable how low rates are, and real rates are clearly negative. I do think there is a meaningful bid for US fixed income assets, and that the Fed is going to be very, very cautious about how it even begins to slow its purchases. Forget selling anything. I think it's going to take them several quarters to find the market, right? They're going to be constantly trying to find the market. And I think that the first step they will take will be to say, okay, we're not going to buy 40 billion a month anymore of MBS. We're going to cut that back to 30. And they're going to talk about doing that, and then they're going to do it, and then they're going to see how the market responds. So I think that when you think back to Bernanke's tenure, it was this very smooth, excellent tenure. The taper tantrum is the only blemish, major blemish. So that's a lesson learned. So I would expect it to be very slow. I do think there's a little part of me that thinks, you know, there's a diminishing return to every human activity. And they've grown the portfolio to the point where I'm not sure it's having a great positive impact anymore on growth or employment. The marginal returns to every trillion you add is probably diminishing. But when you put that thing in reverse, that's a whole different story. And they must be aware of that, if I've thought of it. I'm sorry, I don't know if you maybe muted yourself or I've lost the sound.
Sorry, I was just saying, I was just checking the chat box. I think we answered all the questions, Mark. And so we wanted to, first of all, thank you for your participation in the Pacific Northwest Lenders Conference. Fannie Mae is an amazing partner. You did an amazing job bringing tons of content. We appreciate that, and thank you for speaking today. I'd also like to thank Mike and Francois with American Reporting Company for sponsoring this session. We so appreciate it. And then to quickly, as I close out today, we had an amazing lineup of speakers today, but tomorrow we're coming at you fast, and it's a great lineup of speakers. So please join again tomorrow morning at 8:45 in the morning for the conference.